Okay, um, I updated the front page of your Moodle. Um, Willie and I had some discussions, and we will have group presentations this semester. Shock horror written across your faces. I'm only guessing that because no one, bar one person, has their cameras on, which I'm not happy with. Now I have two people. Three. Any advances? Can you turn on your cameras? Camera's broken. We have 19 people. Absolutely disgraceful, given that there are 66 of you, excluding Willie and myself, registered on the course. A couple of people have dropped out, from what I can see. Anyway. So, back to the point. Yeah, presentations are going to go ahead. And we will run them over 2 days. It's on the front page of your Moodle. Tuesday the 13th and Wednesday the 14th of April. And that is your actually during your last lecture week, which means it frees you up for reading week, which means you can study hard for your alternative exams and finish off the last part of my work, which is due on the 19th of April. So, the format will, of course, be on Zoom, and you will have a 5-ish minute pitch, and you can organize it amongst yourselves who will be the main speakers, so to speak, or split it up, whichever way you choose. In any case, I would suggest that you practice and practice to keep it under 5 minutes. Maximum 5 to 6 slides that you will share with us as part of your presentation. They'll have to be uploaded in advance such that Willie and I can also see them. And yep, and what is it worth? It's worth 10% of your total marks. Handy 10%, you get it right. Anyone, any questions? Hang on, I see a chat coming in here. Let me see what this chat. Don't have a camera, no worries. Now I'm closing the chat again. It takes up too much screen.
Is it just the product we're presenting? So the product idea?
No, the business plan. So the pitch is exactly as you would have seen in Dragon's Den. Here's our idea, what it is, briefly, and this is the market. This is how we're going to make it or deliver it, and this is how much it's going to cost us, and this is how much we expect to make eventually. Okay, so that's kind of bringing you into today's topic, because there's a lot of stuff from today that we would expect to see in your final submissions. I know Willie's given you kind of a template of the structure of the business plan, and not all of it will be applicable in all your cases. Okay, so just because you have a cheat sheet, to use gamers terminology, doesn't mean you have to fill in every one of the boxes. Common sense should prevail. You only fill in those things that are applicable to you. And again, the starting point for filling in those sections will be your business model canvas. So you'll have the final version of that by then, obviously, when in advance of that. So as you can just start transcribing the information into a business plan on the headings that Willie has provided Sorry, I'm just getting my cables sorted out here. Yeah. Um, so that's the kind of roadmap we have for you. Um, now, okay, I'll go through today's lecture first. So all the information, well, at least the information is up on Moodle. The dates, at least, when, and we will take it in team order. Is there anything else about it? No. There's absolutely no reason why this can't work, um, except for you'll be in the camera, not me. We will also have another lecture. There will be three of us on our panel of evaluation. Okay. So that's pretty much it on the point. Right, let me see. Have I got everything? Yeah. Okay, I'm going to start into today's session.
Mark, could I ask you a quick question just before?
Yep.
I wanted to make sure that we're not getting our wires crossed. The business plan itself, just on the Moodle page, it's like 28 to 30 something pages or something like that. But when I was chatting to Willie, he was saying that a business plan, the ideal business plan, shouldn't be very long. It should be 10 pages in some cases, or basically saying that it's not quantity, it's quality. I just wanted to see what you thought our approach should be there.
Excuse the pun. I'm on the same page as Willie. Sorry, he couldn't resist. No, I absolutely agree with Willie as well. You know, it isn't about churning out pages, and I think I was saying that at the very start as well. That 20, 30, 40 pages of business plans can be monotonous to say the least, and really you should be able to do it in a fraction of that. However, if we said only do 10 pages or only do 15 pages, then sadly enough, people say, "Oh, this is a walk in the park. We just have to do this." But again, it's I would caution that if you're doing it, we'd say in 15 or less than 20 pages and so on, you would want to have it really, really concise, and the quality would have to be damn good. Okay, that doesn't mean that you're going to write 30 pages and you're going to have better quality. I would be leaning towards the lower side, same as Willie, provided you write the quality, and that can be easy for you, to be honest with you. If you have all the elements put together and the business model canvas and so on, you can pick off the real gems of information, and populate the business plan headings with that. And another piece of advice on it is that visually presenting the stuff, it's not all about wordage. Very effective graphs and diagrams sell a business, because people are looking. Remember, investors or whomever that are going to loan you money, they want to be able to get the information. They want to internalize it as quickly as possible. Now you see a cash flow statement. To an accountant, that it's like reading a ladybird book. They're so familiar with it. But when you have non-accounting people and you have a diagram and you see boom, boom, boom going negative and then turning and going positive and break even, then you can actually see time, money, how much is going into red, and then it turns up, and then I can see profit. So by 7.5 months I can see break even, and by 11.5 months maybe I can see that they're going into profit, and so on. Or 18 months down the road I can see that they're beginning to make profit, and so on. So I can see it. So the hint there is very effective diagrams, charts, whatever you're using, market segmentation. I would suggest that, for example, Google some of the marketing material and look for presentations, and there's some really cracking ways of presenting the information in PowerPoint, and it can be visually stunning, but more importantly, that how to say, high-end stuff can have a real impact in the information that it's trying to transmit to the receiver. And that's, so you could technically get away with a handful of pages with the right information, and graphs, for example. I would say if you're going to, or when you're using graphs, they need to be about a half page in size so that they're legible. Financial figures, people put these into they're copying their Excel sheet into the Word document, and sometimes they try to pack in the figures as well, and here's the income statement and all the headings and blah blah blah, or funds flow statement or cash statement, and they put that in there, not realizing that that page can be turned horizontally. And when you're reading down through the normal text document, then when you come to these financial figures, you can turn the page sideways, and you can see the information. It's all about how you click with the person's head. You have to make it easy for them to see and understand the information. Because if they find it difficult, not only does it tell you that they're sloppy, they're not professional, they're not, or they could be hiding something. So these are all the kind of advanced insights that we're trying to give you. So whether it's a business plan for this module, or it's some other report that you'll definitely be writing in some job that you're going to eventually, it's all about the presentation, and that creates the perception of the person that prepared it, for starters. Says a lot about the person, the level of detail, the way they're communicating, and so on. So it's I know there's a really long-winded answer to the question, whether it's 10 pages or 30 pages, but I think I'm getting the point across. If you have any doubts, so I'm trying to give you some hints and insights into how to do something really effectively without throwing the kitchen sink at it. Another story. Years ago, I was a second marker on an MBA dissertation, and the student wrote 64,000 words, and I said, this is freaking crazy. The word guideline was around 22 to 24,000, because for a master's it's only a mini dissertation. It isn't a full-blown PhD, which would be about 60, 70, 80,000 words. And so I started to read down through it, and every freaking module that the students studied over the 2 years, they had bits and pieces from all of this thrown in onto this thing. And the original marker had given the student a distinction. I went in and said, that's a fail. And of course there was the proverbial hit the fan, and it ended up having to go because we were using an external university. It was from the UK. I can't remember the name of it now. It's 20 years nearly ago. Anyway, they likewise questioned, and they had to. The head of the department had to travel to the university to argue to bring it up to pass. Now, the fault wasn't only the student writing too much. The fault was also the supervisor for having not stuck to the rules and the guidelines, and so on, and allowed the student to go off and blabber out all this stuff, because it says an awful lot about the student that they didn't know what they were doing. They threw everything at it, so clearly they didn't understand all the stuff they had and how to use it or not use it. Okay, and so to use the expression, less is more. Okay, so I know this has been a bit of a rambling on, but there's a lot of information in there yeah, go. I would be, bottom line would be, I would be a big supporter of quality over quantity, provided you hit the quality, so it's, yeah. Bet you're sorry you asked now, Chris. Anyway, we move on. Okay, I need to enlarge this. Now, this is kind of grinding stuff. Well, not really. There's a lot of stuff inside here, and I'm going to fly through it because you've all done finance, and there's elements of this that you most definitely will want to include in your quality business plans. Okay. Okay, let me go back here so as I can get this thing focused. Yeah, here we are. So, in this one, we're going to I'll just prattle through the learning objectives, the two functions of the financial management of a firm. Because remember, if you look at the title here is Assessing a New Venture's Financial Stability and Viability, or Strength and Viability. And that's what we're looking at in your presentations. Is what they're telling us matched to their finances? Does it stack up? And we need bits of information out of that. And this is what we're going to go through. So you have and again, some of this we've covered before. So the financial objectives of entrepreneurial, the four financial objectives of an entrepreneurial venture. Explain the difference between historical and pro forma financial statements. Now, in all your cases, you're not going to have any historical, right? Because you're a startup, you don't have an existence. Explain the purpose of the income statement and then the purpose of the balance sheet. Then we look at the statement of cash flows. That's one of my pet hates. That's why I keep talking about the graphing of this information. Look at financial ratios, another one of my pet hates. So they're the two key areas that anytime I'm assessing businesses and looking at their performances, these are the two areas that I focus down on. Because if you can't manage your cash, get the hell out of business. It's like having your budget. If you take €100 out of the bank on Monday morning to last you the week, now you can go out on the piss over in Gertie Brown's on Monday night and blow €80 or €90. It'll be a cheap night even, by most standards. But you could blow it and then live on beans and toast for a few days and starve for the last couple of days of the week. Or you could pace yourself. That's simple is as simple does. And that's the same with business. Whether you're running a small startup or a multinational organization, you have to be able to manage your cash. You have to get your money in from your debtors to pay your creditors. And between those two flows of money, you have to make a little bit of profit, pay all your bills and all that sort of stuff. So financial ratios are great indicators in this case. And then discuss the roles of the forecasts in projecting the firm's future income. Be careful on that one. When you're devising your financial plans, don't be over optimistic. We always say err on the side of caution. So take the worst case scenarios when you're doing your financials. If you're saying, for example, you think you're going to get within 3 years you're going to reach 5% of the market, but you're hoping to get 2.3%. Base your finances on the 2.3%. Anything after that is icing on the cake. Okay, so otherwise, if you don't hit your targets, when you go looking for more money, you say, well, you performed badly. You didn't hit your targets. You're not as good as you say or think you are. And that's the message that it kind of sends out. And then what a completely new firm bases its forecasts on, which will be interesting for you, and then explain what is meant by the terms percent of sales method. Now, that's not so important in your case, but in any case, we'll go off. So financial management deals with two things: raising money and managing a company's finances in a way that achieves the highest rate of return. Return for whom? The founders, the investors, the banks, the directors, whoever put money into it. We want something out of it. And that's why we want to see that the finances hang together. And then we'll forget about chapter 10 stuff, but raising money focuses on how New Ventures tracks its financial progress through preparing, analyzing, maintaining past financial statements. So how New Venture forecasts future income expenses by preparing pro formas. That chapter 10 stuff, don't worry about it. You don't have the book, you don't need it. The point is that you need to watch the monies, the rate at which you're burning up cash, and how you can say best guess to see how much you need to get you to the next phase or to the next stage. I've often used the example of building a house, and if you're building a house privately, let's just say you've got a plot of land and you get planning permission, you want to build a house, and you go to your bank and they'll give you the mortgage. They don't give it to you all up front. You'll have to hire an engineer to say that, yep, all the foundations are in and the walls are up, and then the release maybe a third of it. Then when you have so that money, then you have to put in some of your own money to get to that level before they release it. So that's like a bridging. So you need to have some cash starting off, very basic, and get as much of the walls done and get the engineer to sign off such that the bank will give you a tranche of money. And then you're going to use that to try and get the roof on and a few other bits and pieces. And you'll get the next tranche of money. Let's just assume a third of the money. And then you have the final drawdown. So you've got to use the second third to get all the internal fixing and get it almost as ready as possible to live in before they release the final amount of cash. Now, if you run out of money, and if you run... So someone having a bit of a chat in the background there.
I'm so sorry, Mark. So sorry about that.
No worries. Make sure she puts on the dinner for you.
Yeah, very funny, Mark. Very funny.
Where was it? Yeah, if you run out of money at the roof stage and you can't pay the tiler to finish the roof, then you can't proceed to the final phase, and you're stuck. So what you do, you run up bills on your credit cards, much more expensive, and so on. You borrow left, right, and centre to try and get to that stage to get money released. So that's why building a house, you have to be very careful, because the 90% of houses underestimate the actual cost, and that's where project management skills are extremely valuable, such that you can pace the rate at which things are being done, try and get some credit so that you can pay once you've gotten your release of funds from the bank on your mortgage and so on and so forth. Well, it's exactly the same in business. Money comes in and you have to be able to manage it and pay all your bills and make a little bit of profit, and we want to be able to see that happening. So a new venture forecast for future income and expenses. So we will look at that, at what kind of margins you're making and the rate at which you're margin and what way you're controlling your costs. So if we look here at financial management for a firm deals with the questions such as the following on this basis. So these are the kind of things that you need to be ticking off when you're doing your finances. And these are the bottom two parts of your business model canvas: the cost structure, this side, and the revenue structure as you're looking at it. All of this, and I know Willie will be doing some more on the financial side of things next week as well, but that's the basis. I mean, that's why the business model canvas has these two boxes covering or underpinning all the other 7 boxes Of the 9 boxes you have, these 2 big ones at the bottom, they're the foundations that everything else is built upon, for the most part. So how much cash do we have on hand? How much do we have enough cash to meet short-term obligations? How efficiently are we utilizing our assets? How do our growth and net profits compare to those of our industry? So knowing how other companies are performing and so on, what way they're doing things. Will there be funds we need for capital improvements, and where will that come from? You know, you need a top-up loan. You might need to issue more shares. You want to you've identified another opportunity of a side product from the original one you developed, and you might want to develop that as well. Or some new technologies come out that could make you or enable you to build your product more efficiently, quicker, more of them, for example. So we need to buy that new equipment. Where do we get the money? Capital improvement. And are there ways we can partner with other firms to share the risk and reduce the amount of cash we need? So the technology firm that might be building the machines, you might give them part ownership of yours if they lease the machine to you and don't require any payment for 6 months, and you will share some of the profits of the products that you make, for example. Overall, are we in good shape financially? So all of these possibilities, you really have to think of how you can, to use the expression, beg, steal or borrow money and stuff to get your business idea up and running. Okay. Now again, we have these 4 key areas: profitability, liquidity, efficiency, and stability. So again, we'll use our techniques to evaluate these kind of core 4 areas of any business. So if you look here, a company's ability to make profit, a company's ability to meet its short-term obligations. Are you paying your staff, paying your bills, paying revenue, and so on, and paying your creditors, most importantly. Remember, on average, 30 days credit, unless you can negotiate, and legally you're required to only give and get 30 days credit. You can negotiate longer. And now you have the equivalent to small claims courts that companies can take you to get their money out of you as quickly as possible, because let's face it, they have to put bread and butter on the table as well. So if you take advantage of that, they might never give you credit again, for starters. So having how efficiently you're able to meet your obligations, how productively a firm utilizes its assets. So, and you say, well, how does that happen financially? You have machinery, for example, and you're producing 1,000 items per week. That machine costs money. It costs money to run it. And could you be producing 1,500 a week? Could you be producing 2,000? Why is it 1,000? Could you not be doing more? Accountants would love to see the machine running 24/7 to get value out of it. Of course, that's not, well, I was going to say that's not practical. It does happen. It happens over in Intel, for example. But the whole point about it is, if you're running them efficiently, then you can see the return on that investment. You're maxing out the utilization. And then stability, the overall health of the financial structure of the firm, particularly as it relates to its debt equity ratio. So what's your equity and how much debt? Are you heavily leveraged? So you would have covered all of this stuff in your financial management modules, but nevertheless you'll have to use some of these ratios. They'll come up later on. Excuse me. So again, profitability, just jumping down through here. However, a firm must become profitable to remain viable and provide a return to its owners. So the more profitable a firm is, the higher the return potentially it can give its investors in the form of dividends. Excuse me. And then liquidity is a company's ability to meet its short-term financial obligations. So even if a firm is profitable, it is often a challenge to keep enough money in the bank to meet its routine obligations in a timely manner. And that's cash flow. Okay? Can be profitable, but companies don't want to wait till the end of the year to see if they're profitable before they get paid, or suppliers. They want to see, can you meet them on a week-to-week basis or a monthly basis, whatever the case may be. And that's why your funds flow statement and cash statements are so critical. Efficiency, again, if you take the example Southwest Airlines, it uses its assets very productively. Now, Southwest Airlines was the company that Ryanair based its model on. Almost identical. In actual fact, Michael O'Leary went down, visited Southwest Airlines. I think their hub is in Dallas Fort Worth, that airport. It's a huge, huge place. And Michael O'Leary went down there to see their business model, how they operated, quick turnaround times, cheap and cheery and all that sort of stuff. And that's where Ryanair was born after that trip. So its turnaround time, the time its airplanes sit on the ground while they're being worked, unloaded, cleaned, restocked, and getting the passengers on and off. And that's how they drive down their costs. So they're using their assets very efficiently. That's how Ryanair operates. Don't have it sitting around, because if a plane is sitting around for hours on end, it could have had maybe 2 trips, 1 or 2 trips over and back to London, for example, as opposed to the Far East or whatever, using the planes efficiently. So stability, the strength and vigor of the firm's overall financial posture. So for a firm to be stable, it must not only earn profit and remain liquid, but also keep its debt in check. So how much are you borrowing? The rates of interest you're paying. Are you getting the most cost-effective rates of interest? So having the debt-equity ratio identified is critical for you guys. So the importance of them to assess whether firms' financial objectives are being met. Firms rely heavily on analysis of financial statements. And that's the first thing bankers, investors and so on, show me the numbers. Jerry Maguire, show me the money. And that doesn't make sense. That's why I kept saying all the time, that the numbers have to tell the story that your text is telling us. They have to match up. So financial statement, written report that quantitatively describes the firm's financial and so on and so on. Now here you see there, and the statement of cash flows are the financial statements entrepreneurs use most commonly. Balance sheet, income statement and cash flows. They're critical. And your income statement would be essentially your P&L for all intents and purposes. And then how are you actually managing your day-to-day operations or month-to-month operations? That will be evident in your cash flows. Okay. And when you have your cash flows done, based on that, you can actually total all your outgoings, total all your incomes, and you can see your surplus or minus cash flows. And over the 2-year or 3-year period, you'll see your curve. You can plot your cash flow finances or a spreadsheet into a graph. So I would strongly advise you to do a little bit of Googling, hop on the interweb and look at some of these spreadsheets and graphs and how to construct them and so on, if you already don't know. I promise you, YouTube is your best friend, not my YouTube. I mean, that's excellent already, I know that. But when you want to learn stuff, go on to YouTube. How the hell do you think I put all this together? I taught myself from YouTube. But seriously, Excel is fun is one place, and there's a whole raft of others. But look at those sites, how you can get really powerful representations of your numbers. And then of course forecasts. And all I'm going to say, you'll be basing it on future performances. Be realistic about your predictions, your forecasts. Size of market, selling price, you have to be careful on that one. We will look at that later on, but getting the right selling price is absolutely critical. Obviously, if it's too high compared to similar products, customers won't buy them. I say, well, why are they charging so much? And you try to say, oh, we've better quality. Huh. What do you mean? In what terms? I just want a piece of product to do this. Because you have it wrapped in a nice box, better quality? Nah. Made of different material, but I only wanted to do this. I don't need that extravagance. Therefore, quality, forget about it. You can't justify it. If you sell it much lower than your competitors to try and get into the market and so on and so forth, people will snob it as well. I wouldn't touch that. Price is telling me that it mightn't be up to scratch. So getting it right is really critical. Walmart have a brilliant pricing, process. If, for example, I blew the toaster, put the feckin' butter on the bread and then tried to I made a horse's ass of the toaster as a consequence. And I then decided that's ruined, need to get a new one. And let's say I went down to Walmart and said, right, Mark needs a toaster. I'll go down and you'll get all your appliances. They have rows and rows of stuff inside there. And I'll go down and I'll eventually see, oh yeah, toasters, $9.99. I said, Jesus, okay, that's where the toasters are anyway. Special offer, great deal, $9.99. Do you think I'm going to buy that? For a toaster nowadays, probably not. But I might go into that aisle and I see the next one is $11.99, then maybe $15.99, and then $29.99, $13.99, all this sort of stuff for $35 or euros or whatever. And then I'll go down into the line and I see something for maybe 270 euros or 180 euros, and say, I hear for Jesus, I'm only toasting some toast. This thing has 8 sections in it and probably butter it and put marmalade on it at the same time. You don't want that crap. Most likely what I would do is probably say, yeah, 35, there's quite a few of them in around this price range, 35 to 55 euros. I'll go for and I begin to recognize the brands. Murphy Richards, what's this one begins with B? I can't think anyway. All those Krups or something like that. But the first one was probably some weird, wonderful Far Eastern name or something that was totally obscure. You didn't even recognize it. They only carry quantities of stock of the mid-price range. They might have a couple of the very high-end range, and they might only have a handful of the small, cheapy, cheery type toasters. They're very clever because they know once you want to buy a toaster, you won't go for the cheap stuff. You'll want to spend, and because of our perceptions of quality, what we think so the more we're spending, so we have our comfort ranges, and that's why they have the majority of their stock held on site will be in the mid-price range, lower mid-price to higher mid-price, and then you have the upper end pricing. So pricing is really, really critical. It says something about your company to the potential customer. Now we'll talk about that, so there's a whole science on the psychology of selling, and from the buyer's perspective, what constitutes, sometimes we're willing to pay the very high price for something because we want a unique experience. You might pay for a suit to be tailor made, and you might spend maybe 8, 9, 2,000 euros and so on and so forth. You won't do it very often, but you might. Why? Because it's customized and it makes you feel good, and that's all that matters. Okay, but generally speaking, there are niche markets and so on, and generally speaking, you won't be operating in those areas. And then, as I said, forecasts have to be practical. Forecasts, so new ventures typically base their forecasts on an estimate of sales, and then on an industry averages or experiences of similar startups and so on. So where do you find the information? So you'd need to, this is the whole point of realism. You know, what do you think? What are other companies doing? How much are they selling? What kind of quantities are they possibly selling? So can you find out this information? This is all your Porter's five forces, the power of competition in your sector and so on. So you have to find out who are the other players in there, what are their pricing like, and how are they moving? How much of the markets do they have? You might find that out from their financial reports. And then, of course, budgets. Itemized forecasts of the company's income, expenses, and capital needs, and are also an important tool for financial planning and control. Why are they important? They have to be realistic, obviously, but it's given me an indication of what are your costs, what are you budgeting, how are you going to spend your money, and of course, what's your expectation in terms of revenues? Your business model canvas, cost structures, revenue structures, and you plan the next 12, 24, 36 months. Now, of course, 36 months is going to be difficult, but that's going to be all hanging out of your other key area, which is the market segmentation. How much of that do you think you're going to be what percent of the market will you be able to win over the next 12, 24, 36 months? And you would hope that would be expanding and increasing, and therefore quantity by price is revenue, but also your costs will go up proportionately. Can you keep control of those? Can you actually slow down the rate of costs increase proportionate to your revenues? Is that making, yeah, that way, kind of. So if you can keep the angles slightly different, yeah, I think that's looking right, then your profitability increases. And of course, economies of scale. Your economics starts to kick in. Your unit price goes down. The more you make of it. Do you remember the example I made of a machine, mentioned about the machine earlier on there? Do you produce 1,000 per week, 1,500 or 2,000? So the unit cost goes down the more you produce. But be careful of that you don't, if you try to saturate the market, you might force the price down and your profitability might go down the tubes. Well, reduce accordingly. My favorite part, oh yes, financial ratios. And whatever ones you use, well, there will be recommended ones that you should use. So an analysis of its financial ratios helps a firm determine whether it's meeting its financial objectives and how it stacks up against the industry peers. So if you're saying that, for example, your margins are 35 to 45% and the industry average is only 25 to 35%, well, you're out of kilter and it'll stick out like a sore thumb. It might be possible. There might be, your profitability might be based on your cost base, and if you can produce an awful lot more efficiently, then your profitability could be slightly higher. But we start putting those ratios in, it'll start raising red flags. And that's what draws questions and curiosity from investors. How the hell can you be so much more profitable than the industry? Are you missing something? Have you overlooked some costs? Are you being over optimistic in driving down your costs and achieving the higher prices and so on? So a lot of it produces a lot of questions. It could be very valid, And that's where, when you know your stuff, you're able to answer those questions. So the impersonal financial statements, many experienced entrepreneurs stress the importance of keeping on top of the financial management of the firm. So know what's in the bank at any one point in time. So know how much money is going out, the rate at which it's going out, and the rate at which money is coming in. So again, just here's the financial management process. You have your historic accounts. You won't have that. Preparation of forecasts, preparation of pro forma financial statements, and then ongoing analysis of the financial results. That's the flow. You're only interested in from 2, 3, and 4. Obviously, you don't have track records or history. So income and expenses and capital expenditure in terms of your forecasts, and then we apply, once we have those in your spreadsheet, and then you're able to generate your income statements, balance sheet, funds flow statement, then we can apply the ratios, and that'll tell us, is this happening? Now, the ratio analysis is one thing, but there's another point. See the second point here, measuring results versus plans. So you will have budgets, and if you're in operation for a while, you will have actuals. And how well, so if, for example, if you were 18 months in operation, of course, then you'd have 1 year's historic information. But the investors will look at, show me your original plans and show me what's actually happened. How closely were the actuals to your original plan? That becomes critical. If there's a huge gap, again, questions. Why did this happen? Why are your, you had planned on this cost, the actual cost is, 17% higher. What the hell's going on there? How could you have gotten that so wrong? Or 50% higher? It might be legitimate. I need to be explained it. That's why, my own roots in accounting was in cost and management accounting. And I did all of this sort of stuff. And I loved that part of it, investigating the difference, variance analysis, the difference between actual and budget, what was going on. So it was real detective work with numbers. I enjoy that, trying to come up with answers and all that sort of stuff. But that's the whole point about it, to how close or not. And if there's a legitimacy that why there is a difference, and you can explain it. If you can't explain it, and if a whole range of costs are out of kilter, then they say, these guys can't plan for crap. Why would you give them money? They've been too optimistic on this and so on, and they just haven't realized their plans. Their planning is rubbish. So how could I trust them with any more money? That's what it comes down to.
Mark, can I just ask you a question?
Yes, Michaela.
The way we're obviously starting from scratch, where do we say that we first get our initial startup money from? Like, are we saying it's from loans, or are we kind of making up that we have like loads of money in the bank or something?
Good question. Let us assume that you can. There's 4 or 5 people on a team, and to get up and running, you might have €2,000 each, or 5,000, or whatever. You're not going to have €500,000 each, or anything like that. But you have a shoestring that can get you to so far. And in that kind of realism, you might be able to borrow some money. You might be able to borrow 15 or 20,000 from friends and family, of all the members, to be able to generate some cash. And then you need a couple of multiples of that to get to your prototype, for example. And if we can see that, yeah, we can fund you, you're matching that funding, so we're sharing the risk with you. Let's just say you needed 50,000 to get to the prototype. You've begged, stole, borrowed, 20,000. You need another 30,000. We'd say, okay, we're putting in more than you, therefore we want a higher percentage of the company. See, this is the whole point about it. And then you get to the prototype stage, and we say, well, how have you performed? You borrowed You had 20,000, you borrowed 30,000, you got there and it cost you 48,000, you have 2,000 spare. Good. Now we'll fund you to bring you to commercialization because we know you're able to plan and hit your targets. And getting the second tranche of money, you might need 150,000. It would be easier to get that from investors. You're going to have to dilute your company, of course, but you might be in a better position to be able to argue how less or little you'll give in terms of shareholding to the new investors or the additional share issue. Does that make sense?
Yeah, so we're basically just coming up with a figure that we all have each and just work from there.
Yeah, exactly. Look, again, revisit some of the stuff Willie would have shown you on the Dragon's Den. That'll give you an idea of looking for the addition. You'll be at that phase. Let's just say that you have gotten to the phase of the Dragon's Den, and you're looking for more investment from us. So, and any of the Dragon Den versions that you look at, I would strongly suggest look at the UK versions. The Irish versions. I'm not going to say anything. They're crap. They never invest. There was Henry Chevron's girlfriend was on it. What's her name? Can't think of her name now. She had glasses, kind of fair hair. She had a hotel booking type company, made a few million on the thing. That was all she ever did. She never invested in any venture, from memory, that went on to the Irish Dragon's Den. As for the fella that, not Bobby Kerr, the other guy, Bobby is alright. The other fella, can't think of his name. He's a total gobshite. He invested in a tanning company, this natural tanning stuff. It was made from the bogs or bog water or something like that. I call it Creosote. You know, the Yumpa Lumpa paint. Anyway, he invested in that company. It was a really good product, actually. And I think it was a couple of women found it. Not that that makes any freaking difference. But the point about it was he invested, and he himself wanted to be the model to promote this stuff. And I said, yeah, you're for freaking real, you gobshite. I mean, oh, Jesus. That's ego. Anyway, enough I said about them. Just focus on the UK versions of Dragon's Den to get the feel of what you're going to be doing in your presentations, the kind of questions you're going to get, the kind of information you need to package, and work on the assumption that you have some investment yourselves to get you so far, and you need money to go to the next phase and so on. Okay? So, what do we say here? Our projections for future periods based on forecasts and typically completed for 2 to 3 years in the future. That's the kind of time frame you're looking at. And don't worry about this SEC, the Securities and Exchange Commission. You're not required to have any of that compliance. That's for fully fledged companies. I'll fly through this part, and the importance of keeping good records. And you do now. They don't have to be sophisticated accounting packages. They help. You can get quite cost-effective systems. Sage, Take 1, 2, 3, and there's a whole raft of other ones out there. You could even run it yourselves if you've been business degree people. You could run it with an Excel spreadsheet, as long as you're tracking and keeping your records, everything, and keeping everything in place. So New Venture, this is an example of this fitness drinks, just flying down through this. To illustrate how financial statements are prepared, we used New Venture Fitness Drinks, the fictitious sports drinks company. Anabolic steroids in liquid. Anyway, this company has been in business for 5 years, in this case. Targeting sports enthusiasts, the company sells a line of nutritional fitness drinks. Pump me up. And the company's strategy is to place small restaurants similar to smoothie restaurants near large outdoor sports complexes. And the company is profitable and is growing at the rate of 25% per year. Nice, frequent growth if you can get it. And here they produce, the financial statements again. Income statement reflects the results of the operation for a firm over a specified period of time, records all revenue and expenses, and given period we talked already. Balance sheet and then statement of cash flow summarizes the changes in the firm's cash position for a specified period of time and details why the changes occurred. That's done monthly. Okay. And here's just an example here, your net sales. No, it's at 2011, 10 and 9. So you have the 3 years and you can see the logical growth of sales. You can see your cost of sales. And you can see the proportion of how, so you can obviously calculate your revenues, gross margins, net margins, and so on. Just based on all of this, you can start pumping in the information into your spreadsheets, based into your ratios based on this. And current assets, balance sheet, so on and so on. You're familiar with those, and we keep going. And then you have your cash flow for the new venture. Now that's the annualized figure, net income, and for that year and for the previous year. And you can see, look, there's a tremendous jump in net income. And if you go back there and say, look at, well, what's our net sales? Our net sales have only increased by, 200,000 from the previous year, which was only 120,000 from the year previously. And yet the income has jumped dramatically. Am I reading that correctly? 83,000 to 131,000. Yeah, significant increase. So again, does it make sense? Yeah, because they're probably able to reduce the cost. Why? Because they're able to bulk order raw materials from suppliers, and that has its economies of scales, cash benefits, or discount benefits, and so on, so on. So this is how it all kicks in. Okay. So ratio analysis. The most practical way to interpret or make sense of a firm's historical financial statement is through ratio analysis, as shown in the next slide. So comparing a firm's financial results to industry norms, comparing a firm's financial results to industry norms helps the firm to determine how it stacks up against its competitors and raises any red flags. You heard me talking about red flags earlier on. But that's the whole point about it. So here's the type of stuff that you'll need to be including. And for ye God-fearing 19 people, including myself, 18 of you, who've turned up today, you now have the advantage of knowing what to be putting in to your final submission. Return on assets, if you have assets. If it's a service, you won't have assets. Return on equity, net income divided by average shareholders' equity. That will give you a return on equity. Profit margin. Liquidity ratios. Current, quick, overall, debt, and here we have our debt equity. Total liabilities divided by owner's equity. That'll tell you how much your debt equity is. These ones here, see, in 2009, it was 73%. It dropped to 60% and then popped up to 65%. And what could be the reasons for that? Could have been expansion, a couple of new shops, been opened in 2011, so incurred a bit more additional cost for financing that, for example. So there could be several reasons, but as long as you can see and explain the trends. And this is where we talk about information and knowledge. So it's when one ratio for 1 year on its own doesn't tell you a lot. You might be able to compare it to industry average, but it gives you only part of the picture. 2 years, better. 3 years, 4 years, 5 years, wow. Now we can see trends. We can see whether this is going up or going down. If we can see it going down, if we put a trend line overall on this, 73, 60, 65, and then the following year, if we saw it at 57, then we'd see an ever so slightly trend line going down. I said, this is good. They're getting their debt under control, paying off bills, paying off creditors or bank loans or whatever it is. So and that helps with the valuation of your company. So the more that debt is driven down, the more attractive a company is for a takeover or a merger or an exit strategy. Because most startups will have some kind of an exit strategy. The investors will want to return their money within 2, 3, 5 years, whatever the deal is. And you need to be able to pay off them. You might have to raise money to pay off the original investors and give them a return on their investment. They'll set a price, and an agreed price with you, and you have more ownership back in your control to bring the firm to the next level, and so on and so on. And that makes the firm attractive. And you might decide, well, okay, we've driven down our debt, we're making nice profits, it's continuing to grow. Now we'll sell the firm, make a few million, and retire to the boglands. Whatever. Or you might say, okay, we'll sell the firm and start all over again. I love the buzz of the first 3 years. Love the challenges. Can I build something again? So forecasts, the analysis of the firm's historical blah blah blah. So forecasts are predictions of a firm's future sales, expenses, income, and capital expenditures, of course. So on, so on. These forecasts. You're able to calculate your forecasts, do your budgets and financial plans. Sales forecasts, projection of the firm's sales. So this is all contingent on the size of the market. That's how you're able to quantify future sales. So if the market in Ireland, we'd say, is, what's our population? 4.9 million. Let's just say you're selling stuff to men only. That's about 2.5 million. I think it's 51% of the market, or 52% is actually it's the other. Freak! I always forget that. Actually, there's more women than men in Ireland. Yeah, I think it is 52% female and 48% male, something like that. As I say, there's someone for everyone. Anyway, and a few. I was going to say a few left over. Jeez, we shuffled things like that. I think no, I can't remember. I think it was. Anyway, where was I going with this? Oh, Jesus, it's late in the evening. Yeah. So your market is 2.2 million males, and you're only going to sell to between 20 and 40-year-olds. So of that 2.2 million of all males, there might only be 780,000 men in that age bracket. And then you keep whittling down. Marketing people know exactly what I'm doing, so you might end up that your actual market is 390,000 of males between 20 and 40 years of age who would be interested and actually use similar type products that we want to offer. That's the size of your market. That's your total addressable market, 390,000. And of that 390,000, you might say that I would like to get 2% of that in the first year. What's 2% of that? Whatever it is. Let's say 390. That's 78 or 88, 8,800 people in the first year. 3% in the second year. 5.5% in the third year. So you can see the numbers beginning to increase. So they're the number of people that you might buy. And let's just say they're buying your product once a month. So let's just say 17,000 people buying your product in year 3 once a month at X amount, whatever you're charging for it, €5.99. That's your um, that's your market. That's the size of your market. That's your projection. And based on that quantity, which is a portion or percentage of the market, multiplied by the price, that they're your total or gross revenues that you're potentially your company can make. Everything then will fit in underneath that. Can we sell it at the right cost, getting the right price, and so on, so on. So getting your sales forecasts, and as I said, go for the pessimistic projection. Go for the lower side. If you say 5.5%, well, just to be cautious, we'll aim for 5% in year 3, and instead of 1% in year 1, we'd be really sure of getting 0.8% in year 1. Go for those kind of figures. Okay. So factors will affect the future capacity and product demand and so on. So again, a sales forecast for an existing firm is based on its record of past sales, which you won't have, its current production capacities, because remember, if you're going to be selling in year 3 17,000 items per month, you better have the production capacity to be able to produce at least 17,000 and have a little bit of stock left over. You don't want to be carrying stock. That's a dreaded curse. You just want to make it, sell it, make, sell. And in this case, you don't want to be storing stuff because that's a cost. Obviously, warehousing, light, heat, security, costs that you have to incur or else pass on in higher prices, which makes you less competitive. In any case, you might be able to produce 1,000 per week now. You need to be able to start producing 4,000 per week, or 4,250 per week in 3 years' time. So you see how this all has to hang together. And here's just an example of, your future forecast, year sales, year on year, going right up to the forecast for, in this case, 2012, 2013. So you have annual, but you can see them beginning to rise, but there's a steady rise in it. Now, again, you can plot these so you can see your market share that you're projecting, and base the numbers of customers in the market multiplied by the selling price will give you your gross sales annualized, and you can see a trend over the 3 years. Hopefully it's going up. It doesn't necessarily have to be going up at a steep rate. It will be dependent on the your ability to hit the market. In other words, get the 5% or the 4.8% in year 3, and so on. So forecast of cost of sales and other items, again, most realistically, all populated in your cost structures. That's why when you're in your spreadsheets, the first spreadsheet in your workbook, my first spreadsheet I always do is a spreadsheet of all these assumptions. What are my costs? Breakdown. Have I thought of everything? Of course, you have salaries, light, heat, blah, 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 and all this stuff. Cost of suppliers, any other disposable pieces of equipment or raw materials that are direct and indirect production costs and so on. So you'd have to go through everything and make sure, and that's why you have diverse teams. So people say, oh Mark, you haven't thought of this, the packaging that we need to do, and we need to outsource to that company, and what are they going to charge us for this, and so on. So all of that sort of stuff, you put all those, so we make these assumptions and we say, can we get as close or as accurate to the costs? Now we know what the quantities we need to start producing from our market analysis. Then we apply the per unit cost. How much of these? Okay, if it says this company will package 1,000 a week for us at the cost of 77 cent. How much are we going? So obviously that's 77 cent 1,000. That's what, 770 euros it costs us to so multiply it, divide it out. How much are we producing? This is how much the unit cost of packaging is, and the unit cost of light, heat, and so on. So we'll take your bill for run the company and bring it down to the unit cost, multiply by what you're projecting to sell, and now you have your cost per unit cost of your product. Multiply it by the selling price, you have the unit price revenue per product, and so on. Therefore, the rest is margin. So when you have it down to those levels in all the assumptions, then you just gross it all up into your financials. So pro forma statements, I'm not going to go through these because you know how to start putting these. You know about you've done financial management, haven't you? In earlier model, okay. So you know this stuff. What else is of financial statements, and here are the formats of them, or at least the purpose of them. An example of a pro forma income statement for new venture fitness drinks. There you have it there. What else is there? I'm flying through these because you've done them. Back to ratio analysis. Some ratio analysis used to evaluate the firm's historical. We don't need to worry about that. And then this work is completed to the firm's so that the firm can get a sense of how its projected financial performance compares to its past performance and how its projected activities will affect the cash position of its overall financial soundness. Okay, symbols. I told you about one particular website, one2manage.com or 12manage.com. You'll find all the financial ratios and everything else business in that one website. It's a phenomenal resource, but it also gives examples. Some of the content is premium and so on, so you'd have to pay to get access. Most of it, or a large portion of it, is free. Another area that I would suggest that you look at is DuPont ratio pyramid. Google it. But it's a lovely, you'll probably be able to download some spreadsheets that helps you with that. DuPont, as in the pharmaceutical and cosmetics company, DuPont. You can download spreadsheets that put all these ratios together but show how they're connected. So if you have a change in a cost or in some element of cost, let's just say your marketing administration or your marketing communications cost as part of your marketing budget and so on, and your projections, if you make a change in there, it can show how it will affect the profitability of the company in total. So all of these, they're all interlinked. So it's a really, really powerful tool, and we still use it. It's still extremely powerful today. An awful lot of analysts are looking for those. One of the other key metrics that they for companies that are listed on the stock exchange, for example, is earning per share. So in other words, you invest in companies, you buy shares. How hard is that investment working for you? And that gives you the earnings per share. So you can see how efficiently the management team are running the company for you, and how the company is performing. It's a real indicator. If you ever watch Bloomberg TV, for example, or CNBC, when you're looking at the financial programs and so on, you see all the tickers down there, and you listen to the analysts, and they always have guys on talking about the earnings per share in the last quarter and the previous quarter, and forecasted earnings per share for the next quarter and so on. That's always the talk on these when they're talking about analysing firms. Results are going to come out next week, or they're falling short of analyst predictions and so on. That can crucify a company, because the Americans are very much object driven, and by that I mean that results, show me the results, show me the results. And in some cases, if companies don't hit their targets for 2 quarters in succession, they're kind of red flagged and said that bad investment, not a good investment, they're going down the tubes. They can make or break companies, but just splurting crap out, but that's business for you, and sometimes they can blurt stuff out to force share price down and so on and so forth. So there's all sorts of skullduggery going on, can be going on, to buy a cheap company, force the share value down, snap it up, and mergers and takers, acquisitions, goes on wholesale. So DuPont pyramid is one of your is a great tool And again, if you're going to be working in finance or anywhere near it, it also helps you to get an understanding of overall firms' performances and structures, and what parts of the firm are running efficiently or not, or functions, whether the marketing function, the operations, supply chain, R&D, how much investment in R&D is going on, and is this industry standard, and if so, what proportion of total revenue is being spent on future R&D, so you can extrapolate that the company is here for a while because they've got a great product line and they're investing in R&D, so they're going to up this. And sometimes you're looking at technology and you see that company has beefed up its investment internally into R&D, therefore saying, oh, there must be a new version of the product coming out, or they're looking at some new technologies. Keep an eye on that one. So market watch. That's what these analysts do. They're using exactly those tools to try and see what's happening and then say, okay, geez, big investment in R&D here. They must have something. They filed a patent. Now they're probably going to convert that patent into a new product. Therefore, share prices go up. The latest one I saw was, what was it? It was in bike gears, an internal gearing mechanism patent, and whether it was totally wireless driven, and it was one of the big manufacturers that are currently on the market, and there's some kind of predictions that they're going to go down the same route as an existing piece of technology, but might have something better. So that kind of background investigation, and people are looking at this. People are scanning patents and seeing what companies have lodged, and they might see an obscured thing and say, oh, hang on a second, this is interesting. Why are they putting this one out? Because they have to be declared, and you can go in and look at patents, and they might actually say, oh, there's something up here. They're up to something. This company is planning something. And they try to analyze the patent and see how could this be fitting into their existing product lines, or is it something new? And that will drive, and it leaks out, and then bang. So this is why filing a patent is critical to getting it from concept to actual production. So if they take too long when they file the patent, just because they filed the patent doesn't mean that they're totally protected. Some other company might be saying, see what they're doing over there, they filed a patent, we can't do the same thing, but we better come out with something as a competitive and better get our R&D up to speed to be able to counter what might be coming down the road. It's that detailed and that, as I say, competitive. And this could take years in terms of the products actually hitting the market, and so on and so on. And yep. So that's it, folks. The last slide is just the ratio analysis again. So they're the key ones you want to be looking at least or at least including in your business plans and your financial analysis. And then, of course, being able to kind of graph them or show trends in them. Absolutely critical. And that's how you demonstrate quality, to be able to get the information across in concisely in terms of the number of pages that you're going to produce. Now, I know Willie will cover some other stuff in this area with you, but they are most definitely elements that we will expect to see, and how well you produce them, then, well, that's what earns you the higher marks. So, folks, any questions, comments, insults, jokes? I need jokes. Jesus, this lockdown is killing me. No? I'm going to have to lift you off Muhammad to get your dinner. Anyway, folks, I'll let you go, and I'll see you next week, please God. Alright, keep an eye on Moodle. Actually, there's no one looking at those videos that I put up last week. I think I've seen maybe 1 or 2 views. I'm kind of a bit disappointed since I spent my shag week producing videos and people are not looking at them. Critical stuff on teamwork, book and Belbin's role and all that sort of stuff. Alrighty. Take it easy, folks. Talk to you later. Bye bye. Bye bye.
Thanks, Mark.
You're welcome.